There's definitely overconfidence everywhere. I mean, you're seeing it both across the public markets and the private sector. I mean, we're in an 8-year bull market on the public, 9-year bull market on the public, and we're in an 18-year bull market on the venture capital. There's never been more capital coming into the asset class. People are very euphoric. There's lots of billion-dollar plus companies. There's lots of IPOs coming this year. But again, that's a lot of overconfidence. And it always goes back to the economic cycle that we're in. I think you're going to see a downturn. I'm not sure when. I think this oversupply and overconfidence is going to lead us to kind of a pullback, at least in the private markets. My guess is you're starting to see a little bit weakness in the consumer tech space. And I think you'll see some small areas of weaknesses as well on the private side over the next couple of years.
And to that point, we've certainly seen, and I realize that the Chinese tech stocks today are rallying, but in general this year we've seen this divergence between the so-called FANG stocks and the BAT stocks. Some folks suggesting that maybe the Chinese tech stocks turning over, that could be a harbinger of a bigger, broader weakness in tech to come.
So I think the Chinese local markets are strong. They're still very strong in terms of the opportunities, the consumption growth that's happening in China. I think the biggest impact it's had on the Chinese stock is, frankly, is the overall political environment, the trade war that's happening. I think a lot of people are nervous that many of the companies that have talked about coming to the U.S., expanding their footprint, Tencent, Alibaba, et cetera, are going to be pushed back because of the political environment they're in.
And Bob, to Seema's point, broad-based, he's looking at the NASDAQ today.
I always get nervous when people start talking about 1999 because the valuations are not the same. The earnings situation is not the same. They're much stronger generically. And the U.S. economy is not the same. It's a stronger economy than we saw in 2000. But with regard to where the markets are, the most remarkable thing is the rotation that we keep seeing. So remember, momentum stocks, NASDAQ being the classic momentum stocks, had a big dip when we had some concerns about trade and about slowing economy several months ago. They're now back. If you look at some of the big momentum stocks that are out there, Cisco, Amazon, Netflix, Visa in the last month, they have all sort of come back again. That's a huge help to the market. But on top of that, one thing, while the president's legal troubles may not move the markets, we know that trade war and trade tensions move the market. So every single day when there's positive trade war news, we see the markets move to the upside. If you put up, I don't know if you can put up this full screen, but the dollar, since the beginning of the month, we have seen more positive trade news. The dollar has been down about 2%. And reliably, we have seen emerging markets move up. We have seen metals stocks move up. We've seen Chinese internet stocks move up. We've seen U.S. tech stocks generally move up, semiconductors move up. Almost every single day, they move up in exactly the same way. And when you add that to the momentum stocks coming back, you get a real rotation. Finally, we've seen all of the low volatility stocks come in. When tech comes in, you see Lilly hit new highs, Pfizer hit new highs, Procter & Gamble's been strong this month, Kimberly-Clark. This rotation is why you're sitting with new highs on the small, mid, and big cap stocks right now. So it's a remarkable, and it's the U.S. economy, and it's the state of the earnings situation. Even X the tax cuts, we outperform the world on earnings. So it's a lot different than 2000.
So Hany, what do you do as an investor at a time like this? I mean, previous downturns or even the prelude to downturns have been good time for early stage investors to bet on the right technologies, but at the same time, you say there's overconfidence. How do you make sure you're not overconfident?
Well, there's oversupply in, I think, specific parts of the market. Obviously, you're seeing these $100 billion funds plus, and most venture firms that I know, friends that I know, are raising billions of dollars in follow-on funding. So that really pushes them towards the later end of the stage. And so I tend to look for kind of mid to early growth, and I think you're seeing some seams in specific markets. Specific markets that VCs historically have hated, hardware, for example, hardcore tech, I think are really interesting opportunities. You're starting to see that happen both in China and in the US, and lesser extent Europe. I think there's some opportunities along these seams of technology where they're enabling businesses to come up with better products, better driverless cars, better ways to manage your sales force, better ways to manage your consumers. I think there's these themes that I think you're going to see expand dramatically over the next 2 or 3 years, and I think you're going to see a pullback in some of the consumer tech stuff and maybe consumer services that have been so hot in the last 5 years.
When you talk about caution creeping into the private markets, where are they putting their money instead?
Many of the folks that I know well are either pushing the really late stage, these large, $10 billion round, $14 billion for Ant Financials, because they seem and they're deemed as safe because the IPOs are right around the corner. Or they're going very, very early where they're making like long-term bets, 10 to 20-year bets around certain technologies or certain companies.
Huh. Do you think IPOs are going to succeed in the next year?
I think so. I think you're seeing a mixed result so far. I think by and large, I'd say more than half the tech company IPOs have done well, and the other half have not done as well.
But how much better could it get to go public? If not now, when? My heavens, we're at historic highs on the NASDAQ. Everything tells you they're throwing money at companies, and yet the big names aren't coming.
But because being public is a horrible process for most management teams. You're seeing it across the board, whether it's the Tesla guys or...
And that's not changing.
And so... Why not? Why not take a $100 or $10 billion check from SoftBank and stay private forever and manage the business over a long-term basis?
You know how depressing that is for all of us to sit here and watch them stay private, and so the American public can't participate.
Look, I think
in
the short-term nature of the market itself, the public markets, is really a big hindrance for a lot of tech company CEOs to take the company public. You know, we can't build a 10-year, 20-year public or successful company with thinking about the quarterly results.